venture capital is about to change forever. And 99% of founders, LPs, and even VCs themselves don't realize what's about to happen or how it's going to affect them. I know this because we're one of the biggest beneficiaries of all the things that I'm going to discuss in this video. We're an AI startup that is on track to buy 20 companies this year and 40 companies next year. And we've raised over $300 million from the best venture capitalists and private equity investors out there. Right now, I'm seeing three things converge that were never supposed to happen at the same time. PE funds are buying venture-backed companies, venture funds are launching private equity strategies, and even startups are using PE-like approaches to buy their own customers. There is even a term for this now, the pification of venture. Now, here's the good news. If you understand what's actually happening, there's a huge opportunity. Whether you're a founder looking for a new path to scale, an LP looking for returns, or an investor trying to figure out where everything is headed. So in this video, I'm going to walk you through the four biggest shifts that are happening in venture capital right now, the forces driving them, what the smartest firms are actually doing, and what this all means for you. Let's get into it. The first shift that you need to understand is that for most of the last 3 years, the exit window was essentially closed. And even though it's starting to reopen, the game has permanently changed. For most of the last decade, venture capital had a predictable playbook. Raise several rounds of capital, grow as fast as possible, and then IPO 7 to 10 years later. LPs got their distributions, GPs got their carry, and founders made money. But that model broke down. And even as things improve, VCs have learned that they can't just wait for that window to reopen. According to Ernst & Young, IPO activity in 2024 was roughly 1,200 transactions and $120 billion in volume. That sounds like a lot, but in 2021, there were 2,400 IPOs and over $550 billion in volume. That's a 75% drop. Now, there are signs of recovery. VC-backed IPOs are back in 2025, but here's the catch. The bar is higher than ever, and only the best of the best companies are actually getting out. Think companies like OpenAI and SpaceX. And even then, the timeline for liquidity is actually stretching. PitchBook found that for companies worth over $500 million going public in 2025, the median time to IPO has reached 11 years, and that's the longest time in a decade. So even when exits happen, they're taking far longer than they used to do, and more than the traditional fund structure allows. And LPs are feeling it. After years of declining distributions and markdowns from 2021, they're getting impatient. They want liquidity, they want it sooner, and they're starting to look at different asset classes where this is more of a possibility. So what are the smartest VCs actually doing? Well, they're borrowing from the private equity playbook. They're launching continuation funds. Basically, they carve out select assets from an existing fund, letting LPs either cash out or roll over the equity stake. For example, Lightspeed is working with Lexington Partners to create a continuation fund worth roughly $1.5 billion with assets of the 10 most mature companies in that fund. NEA also closed a continuation vehicle of $540 million, and Insight Partners closed their third continuation fund also at roughly $1.5 billion. Another strategy is secondary sales. Secondaries used to be a backwater part of the market, but this is changing. In 2024, buying and selling of secondaries hit $152 billion, which is up 39% year over year. Venture secondaries account for a third of all VC-related transactions, up from 16% in just 2020. And another way that venture firms are looking more like PE firms is net asset value loans, basically taking out loans against the net asset value of their portfolio. The tactics that I mentioned were all previously private equity tactics. Now they're becoming the standard playbook for venture capital firms. If you're a founder, this means that your investors might be under pressure that you can't see and driven by incentives that you don't understand. When taking money from investors, it's worth understanding what their fund and their company strategy actually is. The second biggest shift that I'm seeing is that venture firms are no longer just venture firms. They're becoming full-stack asset management firms. In the old model, VC firms had one product, a venture fund. Maybe they might have an early stage fund and a growth stage fund, but fundamentally they were all the same. They were writing risk capital checks into startups and waiting for exits. Today, the largest firms that we think of as venture capital firms look totally different. Andreessen Horowitz, Sequoia, Lightspeed, General Catalyst, Thrive, they've all registered as RIAs, registered investment advisors. That's a regulatory structure that allows them to do things that traditional VC funds can't. But here's what most people miss. It's still incredibly rare. In 2024, fewer than 24 venture capital firms were actually RIAs. This isn't an industry-wide shift, but rather a shift from the very top players, among firms managing $10 billion or more. So why does this matter? As an RIA, you can invest across asset classes, both private companies and public companies. You can hold positions longer, even after IPO. You can even build new revenue streams like wealth management. And you're no longer constrained by the traditional fund structure. Let me give you a concrete example. General Catalyst, one of the 3 largest venture capital players, has completely transformed their structure. Here's Mark Bargava on a podcast talking about what that looks like now.
We were a venture capital firm, but we're evolving to be really a company. And people ask me, well, what does that mean?
So what does that mean in practice? They've built what they call transformation companies in-house. Companies like Hatco and Perceptor. Hatco is their healthcare initiative. They paid $515 million to acquire a chain of hospitals in Ohio called Sumo Health. They plan to hold on to it for a long period of time and use this as a test bed for their investments in healthcare companies. Perceptor is an AI consulting firm, somewhat similar to Palantir, that helps Fortune 500 companies implement AI. They've even built a business around wealth management to serve their founders better, a customer value fund for helping their startups acquire more customers, more like debt financing, and they even have a creation fund where they incubate companies, and they have $1.5 billion allocated towards just this. So what is the playbook here? The top firms are doing several things. RIAs to unlock new investment types, building businesses that they own and operate adjacent to their portfolio companies that they invest in, operational involvement that looks more like private equity than VC, which has typically been largely hands-off beside board governance. And 4, diversified fund products across the capital stack. So what does this all mean? As a founder, you have to consider the incentive structure of the funds that you're taking investment from. And also, if you're one of the companies that is trying to take advantage of one of these strategies, going with a company like General Catalyst can help, because they have the capital to actually back you in enabling you to achieve your vision. Now, some people hear this and think that it's bad. VCs should stick to venture. That's what they say. But the counter-argument is every other asset class has evolved dramatically. Private equity has evolved and matured. Hedge funds have evolved and matured. Even real estate has evolved and matured. And if VCs are in the innovation business, shouldn't they innovate too? The third shift, and this is the one that I'm most excited by because I work at a company that's actually doing this, is the rise of AI-enabled roll-ups. This is where venture and private equity are truly merging to create something totally new. And it's not just changing how investors are thinking about deploying capital, but it's also changing how founders are thinking about going to market entirely. In the old way, you'd build a product, you'd grind through going to market, sending cold emails, trying to get referrals and intros, and going to conferences. This meant slow, painful customer acquisition for some industries. But there's a new way that's emerging. You build a product, you prove that it works, and then you go out and buy your customers. Yes, you actually acquire the companies that would have been your potential customers, which allows you to own their revenue, their data, and also their distribution. Here's why this is happening right now. For years, VCs largely fished in one pond, software, which is a continuously growing pond. That's more than $1 trillion in global TAM. However, there's always been this $16 trillion TAM that has gone largely unnoticed by the venture capital industry, the services industry. And this is for a good reason. Historically, service businesses were low margin and hard to scale. You can think of them like call centers, HOA management, IT services, ad agencies. Who wants to invest in that? If you're a venture investor, you're trying to invest for 10x or 100x outcomes. And a service business that grows linearly will not actually get you the return that you want. But AI changes that entirely. In a deep dive that General Catalyst did, they went into 70 service industries, and they cataloged things that can be largely automated with AI. They came up with 4 types of tasks that AI is very good at automating: customer success, support, and service. So AI agents can handle this well. Data entry and evaluation, filling out forms, creating tables, content creation like FAQ generation, blog post generation, translation, email responses, and finally basic logic decisions like insurance underwriting. Once they did this, they identified 10 industries where they had high conviction that at least 30% of the work could be automated. But here's the key insight. They only actually target industries with 30 to 70% automation. They don't want all of it.
We target 30% automation at least, but we actually don't want more than 70% automation.
So let's talk about the quick math behind this. Let's say you have a business. What happens when you automate 30 to 70% of tasks, but keep the same cost basis? A business running at 15% EBITDA margins can now run at 30% EBITDA margins. You're basically doubling free cash flow. For some of the companies that they've backed, they're hitting $100 million in EBITDA in less than 2 years. I'll give you a few examples from the General Catalyst portfolio and how this is actually happening in practice. Crescendo is AI for call centers. They've built software that now automates 50 to 70% of what a call center actually does. After they proved this on 10 pilot clients, General Catalyst gave them the capital to go out and buy a call center chain. They were taking 10% EBITDA margin businesses, traditional call centers, and turning them into 40% EBITDA margin businesses, AI-enabled call centers. Another company is Titan. It's a managed service provider for IT services. They went out and got 6 clients and showed that they could automate roughly 38% of the work that is being done. They then bought RFA, a well-known IT services firm in New York. It's basically the same playbook, but a different industry. This isn't just an investor thesis. Founders are starting to get excited by this idea too. As Jeremy Yamaguchi, a founder also working on AI rollups, put it, it's not just a rollup. It's a novel go-to-market motion disguised as a small business buyout. Instead of burning cash on sales and marketing, trying to convince HOA management companies to actually use their software, you could just buy the HOA company itself. Now you have immediate revenue, customer data to improve your models, a test bed for your technology, and also distribution for future products. For founders, this risk profile is pretty interesting because it flips the venture capital model on its head. If you take traditional VC, you're raising money, burning cash, and hoping that you find product market fit before your runway runs dry. In the AI rollups case, you're buying a basket of cash flowing businesses and using the excess cash flow for R&D and also future acquisitions. So you kind of get venture style upside with private equity style downside protection. So here's a playbook in 4 steps. Obviously, different companies operate differently depending on the industry, but here's one way to think about it. So stage 1 is actually building the product and building the solution and testing that in roughly 10 pilot clients. Once you prove that you can get 30% automation or above, then you're ready for stage 2. And the way that you finance this is with traditional seed or pre-seed financing. Stage 2 is buying distribution. Once you've proven you can actually deliver results, you can go to a firm like General Strategist and partner with them to then buy distribution. And you want to buy a company that wants AI transformation. And so once you are actually trying to implement these changes, they're willing and receptive to it. And depending on how you finance the acquisitions of this distribution or of these companies, you might raise over $100 million. Once you've bought these businesses, you actually have to transform them and integrate them. So you need to implement AI across the acquired companies, which is a lot harder said than done. You also have to make sure that the business that you've bought continues to operate as effectively as it was done before. So now you have a 2-pronged problem, effectively implementing AI while also serving the end users of the customers that you've bought. The call center that you bought doesn't stop being a call center the moment you buy it. And the HOA management company that you bought, again, still continues to be the HOA management company. The goal of this period is to increase EBITDA margins through the technology that you built in stage 1, and also continually pull on the other private equity levers, such as increasing revenue through expansions, cross-sells, and upsells. And stage 4 is scale. You use the excess cash flow that ideally you've generated in the previous stage to fund potential tuck-in acquisitions, or use it to expand into adjacent parts of the market. Long Lake started out doing just HOA management software, have now expanded into other verticals like accounting, IT, and a few others. But now you might be thinking, this sounds just like private equity. You've taken a business, you've bought it, you've improved the margins. The only different thing that you've done is you've taken AI and slapped it on it to get cheaper capital. And while it might look like private equity on the surface, it's actually totally different under the hood. These companies are founder operated and they're looking for venture style upside. So they want to hold these for as long as possible and continue to own 10 to 30% at IPO. Now, I should be honest about the risks here. Not everyone is convinced that this will work at scale. As one person put it, in theory, it sounds clean. But in practice, you're building 2 companies, a software company with high margins, scalable distribution, and compounding value, and an operating company with messy workflows, lots of human beings, and daily chaos. It looks great on a slide deck, but in practice, it's like playing poker and chess at the same time. And skeptics rightfully point out that while everyone is excited by AI rollups, very few people have both the domain expertise and the AI expertise to execute on this strategy. One more thing that can be surprising to some people is that the holding companies, the AI native companies that are transforming these companies, typically sit in either San Francisco or New York, where the AI and engineering talent actually lives. But the companies that they acquire are rarely in any of these 2 large cities, or any major cities for that matter. And increasingly, a lot of them have started to go global. For example, a company called Dwelly is rolling up property management companies in the UK, and there's a company doing something similar with the accounting space in Germany. Alright, so what does this actually mean? For founders, if you're in a fragmented, services-heavy industry that is very hard to sell into, this might be an opportunity for you. Build AI, prove that it works, and then buy your distribution. For VCs, this is a great thing. Your TAM has increased 16-fold, but it does require a fundamentally different skill set, operational expertise, and M&A experience. As I mentioned, AI rollups aren't being built to exit in 5 years. They're being built to compound for decades. The inspiration comes from companies like Constellation Software. As I mentioned in the intro of this video, I work at a company called Beacon, and you can think of us as the AI native version of Constellation. Since Constellation Software's IPO in 2006, they've delivered roughly 38% annual returns to their shareholders. Their playbook is deceptively simple: buy niche software businesses, improve operations, generate more cash flow, and use all of that cash to buy even more businesses. Rinse and repeat. These compounders have created enormous value, $100 billion market caps, by just relentlessly executing against this simple model for decade after decade. General catalyst thesis is that we're going to see multiple AI native versions of these compounders emerge. It's a similar model, but as well as the pricing optimization and operational improvements, we'll also start to see AI efficiency start to enter the mix. Okay, so how is this actually different from private equity? The major difference between private equity and these AI rollups is a mindset shift. If you think of private equity, when they buy a company, this is kind of the best version of the company that it will ever be. And so they think of it as an end state, and they just need to improve the operations of what this company has already become. Whereas in the AI rollups, the founders of these companies and the investors of these companies think of them as unbounded upside. Their goal is to grow organically and inorganically as fast as possible for as long as possible. So it's a fundamental mindset shift. One can be thought of as more a growth mindset, and the other can be thought of as more of an efficiency mindset. Another difference is that founders want to continue running these companies at IPO and beyond for decade after decade, with 10 to 30% ownership. This requires a completely different incentive structure than traditional private equity, where fund cycles are between 3 to 5 years. For founders, this can be extremely enticing if you want to build something generational, but it requires having an extremely long-term mindset. For LPs, this is kind of a totally different return profile. It's not VC, and it's also not private equity. It's a longer hold, but you get potentially much larger outcomes. I still think AI rollups are massively underrated right now, and I think they'll go through a cycle kind of like this. It's extremely hype, and we're at the top of the hype cycle. People will start talking about it, but the companies that are already doing this and doing this well will just continue to slug away slowly. And over time, they'll start to improve the margins of these businesses that they acquire. I think it's a lot harder in practice to actually do these things. I know because I work at one of these companies. But if you give yourself a long enough timeline and you're surrounded by an incredible team, and you have a singular focus, it's inevitable that this will happen. Many of the companies that are executing well against these strategies have largely been quiet. They've done very little press, and people know it through the whisper networks in San Francisco and in New York. But that is going to change in 2026. In the next year, a lot of these success stories are going to start to become more and more public. The question then is, how do you position yourself as a founder, as a VC, or an LP to take advantage of this? As a founder, as a VC, as an LP, or even an employee, how do you position yourself against that future? So let's recap the 4 shifts that are changing venture capital forever. The first is that the exit window forced innovation. VCs realized that they can't just wait for IPOs to get exit liquidity. So they've started to experiment with secondaries, net asset value loans, and continuation vehicles. Second, VCs are becoming asset managers. They're building their own businesses, doing AI rollups, and starting new product lines beyond the existing venture capital. The third major shift is that AI-enabled rollups are emerging. Companies are building out AI solutions, testing them with pilot companies, and then going out and buying their customers so that they get access to their customer base, their data, and distribution for future products. And finally, all of this is heading towards a compounder thesis. Instead of looking to exit in 3 to 5 years like traditional PE or 7 years in traditional venture, people are looking more into the future, over the decades to come. So wrapping this all up, what does this all mean? I don't think this is the end of traditional venture. Early stage investing will continue to exist for high risk, high reward moonshots. But among the largest multi-stage firms, a different playbook is emerging. For founders and LPs, what this means is you need to understand the type of firm that you're working with. the pressure they're under, and the incentives that govern them. If you want to go deeper into how roll-ups work regardless of AI, I made this video where I dive deep into the playbook of Alpine Investors, one of the best PE firms to ever do it.